Hello, everybody. It's the end of it's a new quarter. So with the new quarter, it means I have a new end of quarter review to discuss about the S&P 500, or also known as the TSPC fund. I'm gonna go over some of the results and give you a kind of a good idea on how earnings actually are looking and what's going on with the index as far as price performance is concerned, and uh, help you give more information to make better informed decisions with. Okay, here's the areas I'm going to talk about. As usual, index-wide performance results first is what I'll start with, and then I'll cover the sector by sector earnings, actual versus expected, so we can see how the how earnings actually did perform compared to what was expected from them at the beginning of the quarter. And also break down each of the sectors, how they influence that. Also, we'll talk about index price chart with price targets, or it's basically just a price chart of the S&P 500 with lined price targets included in there to give you an idea where earnings really are suggesting that the index price can really be. Next, we'll talk about forward earnings growth projections and index price versus earnings performance. I'll get more into that when we get to that slide. Bond yield data, that's always an important one to look at. It gets talked about a lot. A lot of you guys are not familiar with bond yield information and why it's important to us or how it impacts us. So, as usual, I will talk at least a little bit about that. I don't want to go into too much detail on that, as I have talked about it in the past. And I don't want to become a broken record with drawing out these presentations trying to explain that. So if you have questions on that part, I can help direct you to discussions where that's been brought up before, or previous videos, or whatever. Okay, next we'll talk about bonds versus stocks. Basically, compare what the yields are on bonds versus stocks, or at least the earnings yields on stocks, and give you kind of an idea on what's an ideal stock versus bond distribution if you like some diversification. Okay. Next, talk about the third quarter constituent changes to the S&P 500, and that's just so you have an idea what all has happened in the quarter as far as that's concerned. That it's a regular thing that goes on with the index. I'll get more into that when we get to that slide. I will also talk about dividend stats. And lastly, I'll show you the most recent credit default data. All right, so moving on to the first slide here, we got index-wide performance results. The bottom part here, of course, is what we're most interested in. Third quarter had 498 companies, or 498 tickers out of the 505 get updated. All of the ones that did not update were because they did not report earnings at any point in time between September or July 1st and September 30. All those companies that were affected pushed off their earnings announcements until early October, or so this week or next week they'll be reporting. So that's why that's a lower number. Okay, as a whole, the index did report about 7.39% earnings growth. That's actually a pretty healthy amount. As you see, it's a positive breadth. There's 328 of the 505, there were 328 of the 498 that actually did report, reported positive earnings growth to some degree. 6 reported neutral performance, and 164 reported negative performance. So, all in all, it's a little bit better this quarter than it was last quarter, as you see here, by about 10 companies, and then about 2.5 percentage points as well. So really not bad. And I'll get more into how that actually compared to expectation on the next slide. Okay, so it's about 65.9% of the index reported positive growth. We'll see what we got for a similarity here. Kind of in this ballpark here, I guess. Not a really good comparison. Um, had 62.5% down here, which was closer to this. And overall, the percentage actually looks pretty representative of where this lies in rank compared to the previous quarters that I have records of. So um, it's really not a bad quarter, to be honest with you. It was definitely better than I expected, and I will show you right here how that panned out. Um, I had an expectation of plus 4.17% at the beginning of the quarter. Most of it on the hands of communication services. They don't have the strongest influence. Actually, they're the smallest group out of the entire index, but they're, as far as the number of companies is concerned, but they do have a pretty good amount of market cap. But um, the way I calculated on this, I didn't go by market cap, and overall, uh, everything looks good here. Like I say, communication services and real estate both strongly outperformed what was expected from them. The only ones that underperformed were energy, which doesn't surprise me because the crude oil prices were dropping, and I only look at the forward expectations once a quarter. In the industrials, it was underperformed by 5, almost 6%, and then utilities underperformed by just over 5%. So overall, it's really not bad looking at all here. Um, is it the most upbeat quarter we've had? No, but it's also not the worst quarter we've had. So there's no reason to be overly pessimistic just looking at this information. Now there are other concerns to be focused on, but um, overall, that's not whatever concerns are not showing up in the earnings data yet. Yeah, they might at some point in time. I don't know, but we'll keep an eye on that. Okay, moving on here. Looking at the price chart. This is the 1-year and daily price chart of the S&P 500. So what we're really at is, and not including today's close, which was not good. This is where we ended up at. Basically, S&P 500 was sitting right at right above its 50-day moving average, the yellow line. Looking like it's trying to find support there. Based on just on a zero growth rate, the white line here at 3040 is where I think the index is valued. The buy and hold price target, or what I expect the index to be worth next year, is 3260, and of course the resistance right now, or actually for those of you guys who swing trade. I'm looking at 3150 as being a reasonable topping out price. As you see, it's not getting up that way because there are too many concerns going on with global economics and trade war and other stuff. So, and today's ISM manufacturing report was not it didn't give me any reason to have any optimism, at least as far as that part of the economy is concerned, to be quite honest. So some of these concerns are somewhat justified, although take those concerns out of the way, and the index could reasonably be up to 3150 right now. For those of you guys who are buying holders, just again, don't worry about what goes on in the news. I recommend you just focus on where that yellow line is, where the price is. If that yellow line's above the current price, then stay focused on your stock fund positions. Don't go scrambling to bond funds just because you see prices dropping, because if you don't see that this is coming down with it, then the price drop is not really truly justified. It's more like panic selling, and you don't want to get caught up in that and end up getting whipsawed by watching prices go right back up with you not in it. So I did make a little bit of revisions here with my price targets. I now only have one green line at each level instead of two at each level. You see, so the support level where I'd be buying back into stocks, that would be 3040 if stock prices were actually following the fundamentals. Right now they seem to be more focused on the technicals and the speculative aspects. So as long as those guys seem to be in control of the intermediate or short and intermediate term price tendencies, then it's kind of where I'm focusing right at the moment. But I'm focusing this presentation only on the fundamentals. Okay, swing in target, medium medium volatility, I should say, would be a 29.30 level, which is just not too far below where it closed today. Today it closed, I think, at 29.40ish, give or take a couple of points, I forget. So you're right above that point. Now, could get down to 28.35. Yeah, I would call that getting down to, and 28.35 also happens to be right about where the 200-day moving average is, which is at 28.32. Could we get lower? Yeah, but and yeah, it's always a possibility. Although looking at these, I didn't put the lines here, but if we follow a price channel up here, it looks like it might hold support in it might possibly have some support up here in the 28.75-ish range, or maybe up to 2900 by the time it gets to that point. Don't know, but on the other hand, the price coming down here creates a wedge. Yeah, no, again, I don't want to get too much into technicals, so I probably shouldn't even be spending time talking about this part. I'm more interested in about what the earnings side of the index is looking at anyway. So maybe I should just move on here and go on and show you forward earnings growth projections and as along with index price versus earnings performance. So what we have here is I have all the past earnings, or okay, index close. So this is what third quarter of 2019, which is what we just ended. Basically, move over to here. Remember I said 30, 40. Okay, I round these to the nearest 5. So based on earnings that we just ended, not looking forward at all, the index is worth 30.38, or rounded up to 30.40. That's up slightly, only 0.25% from what it was valued at the previous quarter, which was at 30.30. And you see, if you go back to first quarter 2018, it was only at 24.11, and it's been progressively going up every quarter. Now, the next quarter, I do expect to see a slight drop in overall earnings. So just be forewarned about that. There will be, there's at least an expectation that earnings will drop. However, I think this quarter, looking at it one way, I was also expecting a drop. So I'm at least looking at the 12-month valuation that you see here. So this was expected to be in the negative, but it came out positive. So that was actually a good thing overall. So just because you see an expectation of a negative growth here doesn't mean that it's necessarily going to be negative. It could be positive once the end of the calendar year comes. We'll just see how it plays out over the next quarter, though, okay? But as of right now, don't be surprised if earnings drop a little bit, because part of what happens here is what value, a quarterly specific value, is getting replaced by what other value, and so there could be a decline there, or there could, anyway. But looking further ahead over the next year, it looks upward the rest of the year. I say it'll go back up to 30.73, at least estimated in first quarter, at the end of first quarter 2020, which is above even where we're at right now. And then by end of June next year, I'm projecting 31.87 as the value, and then this time next year, 32.61 as the value. So, and that's where coming back to this is where I got the 32.60 price at. It's basically take current value and then next year's value here, and then the swing out target for those of you guys who play the short term game. I like to go right about halfway between the white and yellow lines. Basically, it's kind of like getting contractor work done. You usually pay about pay them up front half the work as a good faith, and then they do the work, and then in their good faith, they earn the other half by doing the job completely and without problems. Kind of the same thing here with stocks, but the price should only go up to about half of next year's value until it actually delivers on its performance expectation. Then the price should go up. Okay, looking at index price performance versus earnings now on this side of it. Like I said, we got the index close here, and I also have a comparison of how index price actually compared to earnings. Now, what's going on here is, okay, so index closed at 2640, and the index value, or the earnings value, is at 2411 at the beginning of 2018, or at the end of first quarter 2018. And in other words, the index's price was 9.53% higher than what the trailing 12-month value is here. So what that means is that there was an implied growth rate of about 19.07%. As I say, this is about half of the next year's value. So, uh, looking back, we're in double-digit growth rates there, and then when stock prices took a dump in at the end of 2018, you see it was down quite a bit below what the trailing 12-month value is. But now, good example here. 27, 23 was where we were at. So implied growth rate about a year later would be a 14% growth. 1, 2, 3, 4. So if we were to take 30, 38 and divide by the 27, 23, what we really got was about 11.57% growth. So it wasn't too far off in terms of reality. So we were fairly, maybe just a little bit irrational there, or we're pretty close to what was, legitimately expected at the time. But when fourth quarter 2018 came around, prices dropped quite a bit lower than what was legitimate. So looking right now, we've got 1, 2, 3, 4. So we're looking at 30.25 versus 29.27. That's a 3.35% growth rate expectation over that year. So in reality, it kind of gives us an idea that the price was irrationally low at this point in time. But moving on here to the third quarter, right now the index is of course below its TTM value, or trailing 12-month value, which does imply a decline in earnings over the next year. But as you see, I'm projecting upward, not downward. So this kind of gives you an idea that what's perceived by investors is, at least as far as the price behavior, is not in line with what earnings expectations are. They're in disagreement right now, and I always follow the earnings side more than anything. Until I start seeing the earnings actually going downward or underperforming expectations, which I haven't seen yet, then I wouldn't worry so much about what goes on with the shorter term price behavior, and just focus on the earnings. And sooner or later, if the earnings keep going up and or meeting or beating expectations, and the index continues to underperform, then it means it's more reason to believe the index price will eventually come to its senses and climb back up. So all in all, we're almost 200 point, or right around 200 points lower right now than the index could really be trading at, based on what the current earnings growth projection is at, in a nutshell. But of course, the perception is that it'll be in a decline over the next year. All right, so moving on now, let's look at the bond yield data. Now these are all really low rates. 10-year yield is down at 1.69%, and you do see some inversion going on down here. See now what we refer to as an inversion means that these shorter term prices are higher than these shorter term yields, I should say, are higher than the longer term yields. Now these aren't higher than the 30-year and 20-year, which we got 195 and 213, versus the 1 month is only at 190. But as you see, it kind of bows downward before it goes back up. There's always a concern about whether this portends a recession or an economic decline, however you want to refer to it. Doesn't necessarily mean it's going to happen, because like I say, these inversions can often happen anywhere between 9 months and 2 years before a recession actually happens, if that even happens at all. They usually always, they usually always, recession usually always does occur after one of these by around that point in time, but it doesn't necessarily mean it will happen. We always have different economic conditions every single time to work with. So just because something's happened every time in the past, so many occasions, doesn't mean that it's going to happen this time around. So, but yeah, you can play the percentages and the probability, yeah, if that's what you're into. But stock prices are going to continue, have been known to continue to rise for at least a good 9 to 12, 24 months, like I said, after an inversion does happen. And so what's that tell you? When stock prices do peak, it can't actually be because of this bond yield information. The bond yield data might be an influencer of the overall economic conditions, but evidently it doesn't have a direct impact on stock price behavior in the long term, because like I say, if it did have a direct impact, then stock prices would fall as soon as an inversion would happen and stay down. That's not happening, and we're not in any kind of economic decline. There are some areas of decline, yes, um, that actually could lead into that, but um, the moment that's not what's really going on. So this is also why there is pressure for the federal, or for the FOMC, or Federal Open Market Committee, or as you might call it, the Fed or Federal Reserve, whatever you want to call them. It's technically the FOMC, to lower interest rates, because when they lower the federal funds rate, the shorter term yields over here are the ones that are more sensitive to it. So they tend to be more in line with what the FFR is. So the most recent FFR, or the interest rate policy change that just happened recently, they had lowered it a quarter of a point to a target of 1.75 to 2.00%. So as you see here, everything in that 1 month down to maybe a year uh, bond yields, maturation lengths, those are all in that same neighborhood as where the FFR actually is. Um, Ironically, these are also there, but this is kind of an implication that bond investors or speculators, or economic speculators, I would say, think that bond yields are going to drop, or that the Fed that they should bring the uh, Fed funds rate down some more. So if they do drop the interest rate down, let's just say to one, it looks like they're kind of pricing in here, at least on the 5 year, 7 year, 3 to 7 year range, kind of pricing in a drop to maybe a 0.5% drop from where it's at right now. Uh, and that would help with our economic conditions. Um, anyway, like I said, we'll keep an eye on that. It's nothing to really be overly concerned with right now, because there are two ways we can correct an inverted yield curve. One would be for the Fed to drop interest rates and bring these short-term bond yields down more, to create more of a step up like that. This is what a bullish bond yield looks like. The way I'm pointing this right now, coming upward like that, is what we like to see. Or even like not a parabola. Uh, gradually climbing like that, where it gets steeper as you get further down, further to the right. Those are good kind of yields to see. But like I say, Fed dropping interest rates here is not the only way to fix this problem. The other way that can be fixed is for bond investors to stop buying up these medium and longer term bonds and let the yields climb back up, because as bond investors are buying up bonds, they're going to push the yields down, and when bonds sell off, the yield rises. And right now, because a lot of foreign bonds, like say Germany's Bunds, and even other countries' uh, bond treasuries, basically. See, a lot of them are in the negative interest rate right now, so you can't get any kind of growth out of the investment in those areas. So foreign bond investors are basically pouring their money into U.S. money bonds because our bond yields are so high compared to what they can get in their own areas. So that's part of what's factored into this. It's not, and I think could be some bearish sentiment from domestic investors as well. So anyway, it's I think that's enough beating on this horse here. Hopefully, you guys get at least some better understanding of this. There's more to it that I've talked about in the past. I won't go into it now. Just watch some of my other videos or some of the other discussions in the TSP group on Facebook and uh, get some more insight into this. Okay, moving on here. Bonds versus stocks. Right now, I have a projection of plus 7.32% growth or earnings growth over the next 12 months for the S&P 500. Now, I did have to make an adjustment recently because of the way I was calculating earnings and projected earnings in the past. It worked great for a while, for so long, but then we just had a recent constituent change within the last week that um, basically caused one company with barely like $3 or $4 per earnings or whatever it was for over the course of a whole year get replaced by a company that had over $200 per earnings. So it created a very skewed figure on what my actual earnings data was saying. So we ended up coming up with some modifications to the calculation process to come up with a similar what should have been where it should have been in the first place. I had that change not taken place, and it was too small a company to have that big an influence on the broader index earnings. There was only the company only had 13.3 billion market cap, which is actually pretty small by S&P 500 standards. Comparatively, Microsoft is the largest company in the index, and they are at over $1 trillion in market cap. So that tells you how tiny this company that just came into the index really is compared to the big guys. All right, so basically this implies that it's 80% stock, 20% bond distribution ideally. That is what I have in the announcement post in the group. If you aren't already familiar with the announcement post, I suggest you look at it, and make sure you click on or tap on the read more part of the post if you're only seeing the excerpt version of it, so you can see all of the post. All this information is in here and there, and I do have recommendations on which funds you should consider, how much of each of those 80 and 20% to go into, if that's what you're more focused on. All right, moving on here. Now, this is the constituent changes. There were 6 of them that occurred this quarter, which is actually right about in line with what normally happens every quarter. Normally about 24 companies get replaced in the index every year. So every quarter, an average would be right around 6, 5 to 7, I would say. And we had 6 this quarter, which is actually normal. Yeah, I think last quarter, if I remember right, was on the not so active side. As you see here, at least the first 3 were caused by companies being acquired by other companies. First one was L3 Technologies. It got replaced by Market Access Holdings. L3 was acquired by Harris Corporation. Then a couple weeks later, T-Mobile was added to the index. They replaced Red Hat, which was acquired by IBM. And in August, had Leidos Holdings get added, and they replaced Anadarko Petroleum because Anadarko got acquired by Occidental Petroleum, which is also an S&P 500 company. IEX or IDEX Corporation replaced Foot Locker due to market cap change. Basically, Foot Locker was too small to justify staying in the index, and IDEX grew out of the smaller S&P 400 mid cap index. So basically, they swapped places. Foot Locker went to the S&P 400, and IDEX got promoted to the S&P 500. So that's how a lot of these, how the indexes are. Some of the ways that the indexes are tuned to always move upward over the long term. Okay, and then just this last week, CDW Corporation replaced Total System Services because TSS was acquired by Global Payments Incorporated. That's another S&P 500 company, by the way. Um, and then lastly, NVR. This is the one that skewed my earnings data. I think that was the one. They replaced Jefferies Financial Group. Jefferies was basically, they shrunk because they spun off the Spectrum Brands Holdings Incorporated, and basically what was left of Jefferies was left them too small to remain in the index. So that's, yeah, and then NVR got promoted out of the S&P 400 as well. So all in all, like I said, this is a very normal quarter as far as constituent changes were concerned. All right, moving on here. I think this, no, there's one more after this. I like to look at dividend data across the index to get an idea of just how bullish or bearish companies in the index seem to be. So basically, the higher the score is here, the more dividend raising activity there is across the index. Now, there are 423 companies in all in the index that do pay a dividend. So if you look over here at 2018 fourth quarter, yeah, the quarter where the price performance was terrible. Earnings performance or companies must have been pretty bullish at that time, because 159 of those 423 companies, or roughly, it might have been a few different because of constituent changes or companies adding or subtracting dividends or whatever. But a pretty good portion of those dividend payers raised their dividends that quarter. Now, it has gone down progressively over the quarters. However, we've found some stability here, it seems. Like I said, the end of last quarter, only 72 companies, or actually the score of 72. Now, these scores, it basically takes the number of increases and subtracts the decreases. So, like in here, consumer discretionary, you see how there's three increases and one decrease, so their score is going to be 2, not 3. So that's kind of how I work it. So if there are more decreases than there are increases, you're going to see a negative number here. So 75, basically it was 76 increases with one decrease, as you see here. So a score of 75, which is still slightly better than it was the previous quarter. Consumer discretionary sector, it dropped quite a bit from 12 to 2. It was pretty stable, so that is something I'd be a little concerned with, because consumer discretionary companies are cyclical in nature and very sensitive to economic conditions. So when the dividend increasing activity drops to near zero in that sector, it is something to be at least a little concerned with. Doesn't necessarily mean it's a problem, but I mean, it could just be that they coincidentally just didn't do increases this quarter, but might have done more, like, at a different time, like the previous quarter, and the next quarter they might pick back up, for all we know. But like I said, it's just something to keep an eye on. Let's hope it picks back up to some extent. Now, something that is a positive sign, though, looking over here at the financials, we saw basically an almost a twofold increase in dividend increases in the financial sector, and it was virtually all bank stocks. As I was going through these, it was almost like clockwork. As soon as I saw a bank stock to look at, it was almost a guarantee that their dividend was increased from what it was the previous quarter. They say there might have been a couple there that did not increase their dividends, but like I say, it was like clockwork. Almost every single time I saw a bank stock, they actually did raise their dividend this quarter. So that could be a positive thing there, because this tells you that bank stocks seem to be bullish in their sentiment, which is a good sign. Okay, industrials, that was another one that had a twofold increase. It's not quite up to the levels it was at the end of 2018 or beginning of this year, but it still looks a lot better than it did last quarter. Information technology, same situation here. It's, well, not double, but it's at least a step back in the right direction. So all in all, not too bad. I'm glad to see that the total number has seemed to stabilize. We'll just keep monitoring from quarter to quarter and see if that changes. Let's see, this is still kind of an ongoing thesis here that the sentiment, the dividend change increasing activity here, or dividend increasing minus decreasing activity, should give us a pretty good idea of the perception of the companies themselves of how what's going on with their future earnings growth, because they're not going to increase their their dividend if they don't think their earnings are going to grow. And likewise, if they do have an expectation that their earnings are going to drop or actually are dropping, usually once the earnings actually are dropping, uh, they'll try to avoid decreasing their dividend amount as much as possible, because they tend to lose investors if they drop their dividend or even cut their dividend. So it'll make their stock price a lot more volatile as well. So they really don't want to be decreasing dividends if they can avoid it. So they'll usually let earnings come down first, and if they'll get to a certain threshold, then they'll decide they'll either decrease or slash the basically slash, I mean eliminate their dividend before. But they'll wait till that line in the sand gets drawn before it actually hit, before they actually are going to get to that point. So companies always have an incentive to try to either maintain or increase their dividend if they pay one at all. All right, so keep an eye on that. Again, move on. Let's look at credit default data now. This is the last slide here I'm going to talk about. Overall, it doesn't look too bad here. Now, bank cards, at least on the chart, to me, it looks like it had the more long-term problem. Looking at the mortgage and auto loans, at least looking at this number, at the lines here, it doesn't really look that bad. I mean, it looks like it's actually pretty stable, which is a good sign. Now, it isn't a recent uptrend. It could just be a short-term thing like what we see here, though. And it could flatten out and kind of stay in that, right around 1% range. That's a stable economy. As you see here, when the Great Recession happened, it shot up. At the beginning, mid 2007 or so, which actually happened before the S&P 500 and other stocks saw their price peaks. The S&P 500 peaked in October of 2007, before the Great Recession happened. So right in this area here is where the stock prices actually peaked. And then, of course, on the downfall, now everyone's losing jobs, and now they can't keep up with their credit bills. So this is how the default rate goes up. But right now it looks mostly stable. Like I say, this little uptick here in the most recent month is not something that would concern me unless it sustains itself like you saw here. And also, what we still have first mortgages as the lowest default rate, so that's another positive sign. You saw here in the Great Recession, the mortgage defaults actually skyrocketed up above auto defaults. So now that's kind of just more of a sign of just how the flaws that existed in our home mortgage process back then. So ideally, I'd like to be able to see it stay like this, where credit card defaults are the higher rate, because they're not as critical to people's ability to live their happy lives, and then auto loans in the middle, and then mortgage defaults at the bottom. So this is like I said, it's a good sign overall. Okay. All right, well, that's all I have on this presentation. Like I said, it's probably went on a little bit longer than I really wanted it to. I want this to be informative and good use for you guys, to help you make sure that you're making the right decisions with your money, whether it's TSP or elsewhere. This can help you out. Okay. All right, that's all I have for now. I appreciate you taking the time to watch. Thanks.